I'm Sanjeev Pandya, welcoming you to this week's edition of the Tax Talk with AJ right here on ITV Gold. The show is brought to you by Science CPA Services, a full-fledged, complete professional accounting firm. Multiple locations in the state of New Jersey can assist you with your personal tax matters, business tax matters, or anything to even manage your business, virtual CEO, virtual CFO, or payroll services, bookkeeping services. That all can be done by Science CPA Services. They're on-hand, knowledgeable, and experienced CPAs will handle all these matters and take care of it while you focus on business. That's what Science CPA Services is all about. On top of all these services, they can also assist you with IRS tax audit. God forbid, if you're in IRS tax audit, then immediately contact Science CPA Services and they will definitely help you from start to finish with that audit matter because they're very experienced in that category. Science CPA Services can be reached at 908-888-8900, 908-888-8900, or visit their website, sciencecpaservices.com. Every week, Mr. Ajay Kumar of Science CPA Services, with over 30 years of experience combining CPA, CVA, and MBA, and still going very, very strong, joins us in this show to guide us, to inform us, to educate us with his knowledge on taxes and taxes-related matters. So we welcome Ajay to the show. Ajay, good to have you again.
Thank you, Sanjeev. Thank you for the kind introduction.
Sure, most welcome, because I know Science CPA Services all these years, and I know that how they have a satisfied clients. They have the highest rate of satisfied clients because Science CPA Services believes in doing one thing, which is taxes, doing right. That's what they believe in it. All right, moving on to the show, viewers. Today we're going to talk about millionaires' tax strategies. You are a millionaire, you want to be a millionaire, there are a lot of benefits when it comes to taxes that you can definitely claim on your tax return. Not all of them, but most of them or some of them can definitely apply, and that will definitely help you to get to the bottom line of your tax return. So millionaire tax strategies, where perhaps you never hear it from anywhere else, but only in this show by AJ. He brings his wealth of knowledge and experience in highlighting millionaire tax strategies, and we're gonna have discussion on that topic in today's episode. Just a couple of weeks ago, there was a millionaire tax strategies seminar, including with the presentation held right here in ITV Gold Auditorium, which was attended by a record number of individuals who gained a lot of knowledge out of that. So we're gonna bring you the precise, short and a precise format of what was discussed in that show, in that seminar rather, in this show, Millionaire Tax Strategies, which is for entrepreneurs, wealth planners, bankers, and many other individuals who fall in this category. So we're going to start with the Millionaire Tax Strategies. Ajay, once again, good to have you here, and congratulations on the super success of that event.
Absolutely, Sanjeev. You're 100% right. We were sold out. We had a lot of people calling, requesting a show summary. So this is an attempt to bring what we had in the live seminar a couple of weeks ago. This show, we will try to discuss 10, 12 strategies. In the interest of time, we'll keep it crisp. If you need more information on any strategy, please reach out. Please remember, please understand, not every strategy is meant for everyone. There may be some strategy that fits you more than other strategy. And remember, a lot of people are saying the same thing. Rich people don't pay taxes. There is a reason. There is a process. You have to be compliant. You have to understand the rule. If you pay more than your fair share, nobody is going to come back and say, hey, you paid me $100 more. The onus, the responsibility remains on the taxpayer to pay the fair share, the lowest taxes as per the law, and stay compliant. So please stay tuned.
And who could be better person to say with that sentence more than the President of the United States, Donald J. Trump?
There are a lot of examples like
yes,
that, Sanjeevji.
Exactly. Not only millionaires, but billionaires also follow the same thing.
You have to know the rule. You have to know the law.
Yeah.
Only then you know how do you use the law in your favor to pay the minimum tax possible.
Absolutely. All right. So let's just start the today's topic. You know, when you are a millionaire or multimillionaire or a billionaire, right? One thing always is a common on their tax return, which is capital tax. Because without capital tax, you would not be able to go that far. Capital tax also because of investments and everything else. So let's start with monetize installment sales, which also highlights capital tax.
Absolutely. So you're 100% right. Most people will have capital gain tax in their tax scenario, especially if you are well-to-do. It's very, very common to see that. So in monetized installment plan concept, the idea is when you sell an asset, it could be a business, a real estate, whenever you're selling, especially the intangible asset, whenever you're selling an intangible asset, a business, instead of taking the money now, if you say, give me the money over the years, in 10 years, in installment, so it's not a sale now, it's an installment sale, you're not charged taxes now. Let's say if you're selling a business for $1 million, you tell the buyer, give me an installment plan, give me 100,000 every year for next 10 years. So the taxes you pay is only on 100,000 every year. But now you say, hey, but I need the money now. I need to invest this money into the next business. I hear you. So what you do, you take this installment plan. This is a loan agreement. The buyer is giving you in writing that they will be paying you 100,000 every year, personally guaranteed by them. You take this note, it's called installment plan, to any bank based on the buyer's credit history, based on the buyer's credibility, because it's guaranteed by them, guaranteed by the business, guaranteed by the buyer. Bank will loan you up to 70% of the money easily. So you got the loan, but you say, hey, I got the money from the bank. Do I have to pay tax on that money? No, loans are not taxable. So you sell the business on installment sale, take this note, the installment plan, go to the bank, take the loan against this installment plan. So you got everything. When the buyer pays you, you pay the bank. Buyer pays you, you pay the bank. So you got the cash now, and the tax you pay is only $100,000 income right now, and everything else is deferred for the next 10 years. That's the concept here.
Okay, very good. Good point. AJ, I just want to correct one thing. A question comes to my mind that whatever we're discussing, these millionaire tax strategies and all the tax-related benefits that you're going to be sharing with us in the show, are they going to be the same once the big beautiful bill kicks in, let's say from next year, when they file 2025 tax return? Are they going to be the same, or there are changes? And if there are any changes, you're going to have updated information in this episode.
Absolutely. So there are changes, and we have modified, updated the information based on the changes that we know of. But please remember, not everything, not all the changes are applicable this year in this big beautiful bill, and we have a separate episode on big beautiful bill. I mean, if you go to our YouTube channel, Size CPA Services, you will see a separate episode on big beautiful bill. So we have changed the content of this episode based on the changes that we saw in big beautiful bill. But again, not all the changes in the big beautiful bill are going to be implemented, applicable right now for this year. There are some changes that applies to next year. So there are a lot of changes over there.
All right. This disclaimer was necessary, so at least our viewers are aware of it. Okay, so after this monetized installment sales, let's go to captive insurance.
Absolutely, Sanjeevji. So captive insurance is a great concept. You can, for this year, for 2025, you can push up to $2.8 million into captive insurance and claim this money as a deduction for your business. But remember, captive, before I give you the concept, before I explain you how the captive insurance concept works, captive insurance has been on IRS dirty dozen list. If you ask IRS, give us the top 3 scam for the last 3 years, you will always see captive insurance as one of them. So that's the beauty of it. Where I'm going, you have to know the concept and you have to make sure you implement it properly. Keep it compliant, use professional help. A lot of misuse around. Just because the concept is so beautiful, the concept is so good, a lot of people can save a lot of money, hundreds of thousands of dollars if you are in the right category. That's why the concept is a misused concept. But let's go to the core of the concept. How do you save taxes? By using captive insurance. So the idea is you create your own insurance company. Instead of paying the premium to the insurance company, you pay the premium to your own insurance company. And what do you cover? You cover the risks that are generally not covered by the insurance company. So all insurance company cover general liability, workers' comp. The basic insurance is everybody covering. But what if you have a situation, a unique situation? And how do you find that unique situation? You can do the risk analysis. So the captive insurance, people who implement captive insurance professionally, they will do risk analysis for your company. So when we had this situation, hey AJ, if you gain weight, you get cranky. If you get cranky, you don't talk to the client nicely. You lose client. So gaining weight is a risk for your business because you will start losing business. Do you think insurance companies cover Ajay Kumar's gain? Nobody wants to cover it. So the idea is you identify certain risks that are unique to your business. Then you have the insurance company cover that risk. Let's say AJ's weight gain is $500,000 of premium. Who am I paying this $500,000? To my own insurance company. When you have the professional liability, workers' comp, general liability, all those insurance premiums are tax deductible. AJ's weight gain is tax deductible as well. It's just like any other insurance. But I'm paying this premium to my own insurance company. So I keep paying $500,000, $500,000, $500,000, and I keep claiming this $500,000 as a deduction. After 2 years, after 3 years, after 5 years, I close the insurance company that I own, take all the money out, and now I pay capital gain taxes, not the regular. The idea is when I was giving the premium, I was saving 37% taxes, regular income tax. When I took the money back, and it has to be at least 1 year, meaning longer than 1 year, so it's long-term capital gain, I pay only 20% tax. So in this situation, I created a tax arbitrage of 17%. How much the premium you say? Remember I said 2.8 million? So up to 2.8 million can be pushed into this insurance company for this year at 17%. You do the math. $500,000 of saving just by implementing captive insurance right.
This is mind-boggling information on captive insurance, and still with all these benefits, still it remains one of the most fraud items. The thing that people go out and make fraud in this category. This is very interesting to know. Anyway, folks, we have more coming up for you right here in this show, the Tax Talk with AJ. After this messages, stay with us. Welcome back to the second half of the Tax Talk with AJ. And of course, the show is brought to you by Science CPA Services. But this part of the segment is sponsored by Suhag Jewelers, a beautiful, elegant jewelry showroom located on Oak Tree Road in Islin. A glittering, full of lights, glamorous showroom located on Oak Tree Road in Islin. And that showroom has a beautiful collection of gold, silver, diamond, platinum jewelry that immediately you will fall in love with it. So make your next purchase at Suhag Jewelers. And remember, gold investment is always a safe investment. With that note, Mr. AJ will announce a gold rate for your information.
Absolutely, Sanjeevji. Thank you. So gold has been extremely strong. Gold rate today was $3,400 per ounce. Again, the gold rate has increased slightly compared to yesterday. We expect the gold rate to remain strong.
Yes, gold investment is always a safe investment. Whether you're buying a gold jewelry or gold bar or something, that is always recommended to be a safe investment. And remember, visit Suhag Jewelers for your next purchase. Whether it's for any festival, whether it's for a birthday gift or anniversary gift, or for no occasion, you just want to say someone that I love you and I care for you, you'll find all the occasions appropriate gifts at Suhag Jewelers. You can visit their website, suhagjewelers.com, and of course visit their showroom on Oak Tree Road in Islin, New Jersey. Moving on to the show, the Tax Talk with AJ. In this episode, we are talking millionaire tax strategies that will really help you to understand that how millionaires' tax returns work and what are the deductions that they are definitely allowed to take. Even if you're not a millionaire, I'm sure that you aim to be a millionaire. So even with that scenario, this will help you to get all the information. All right, AJ, after covering a couple of topics, monetized installment sales and a captive insurance, let's talk about carried interest. What exactly is carried interest and how long can you carry it on your tax return?
Absolutely. So, carried interest does not have anything to do with carrying part of it. The concept here is, how do you avoid paying the regular income tax? How do you pay long-term capital gain tax? And the key differentiating factor, and you will see the same concept again and again, Sanjeev ji. People don't want to pay regular income tax. Regular income tax is as much as twice of the capital gain tax. If you are in low income tax bracket, your regular income could be 30%, but then capital gain tax is 15%. If you are in high income tax bracket, your regular income tax rate is 37%, your capital gain tax rate is 20%. So everybody wants to pay long-term capital gain tax as opposed to regular income tax if they can choose it. So the concept behind carried interest is, some of these bankers are hedge fund manager, some of these people who are helping you invest money, wealth builder, wealth managers, what they do, instead of taking a salary, instead of taking a fixed compensation, they say, I'll charge you 1% of the return that you're making. I'll charge you some carry. So they have skin in the game. And just because they have skin in the growth of the asset, it's seen as long term. They have to keep the money for a certain number of years over there. So the way the concept works, the money that's compensated, the compensation that's based on the growth of the asset, where we see skin in the game. I mean, they don't get it if they don't perform. That part of the compensation is referred as carried interest, because they have interest that they're carrying for a longer duration, and that carried interest is taxed at a favorable rate, long-term capital gain tax rate as opposed to regular income tax rate.
Okay, long-term capital gain and short-term. These are the key things in carried interest. You know, this another topic which is also needs some more light and some more guidance from you, which is the private placement life insurance known as PPIL. What exactly is PPIL and how does it work?
So private placement life insurance company it's an insurance plan. And you say, hey, I know the insurance plan. When you give money to the insurance company for life insurance, especially if you consider the whole life or universal life type of concept where you pay slightly more money every month, every so often, you don't decide where the insurance company is investing this money. But how about if you could put more money than the minimum required money and you had certain control on where this money is being invested? Privately placed. And the best part, these are private contracts, meaning these contracts are not publicly known, so they are protected from any lawsuit, anybody trying to come behind you. The insurance contracts are protected contracts. So you have control on the asset, you can overfund the asset, you can take a loan against it. You say, hey, if I put all my money into PPLI type of plan, wouldn't I run out of money? What would I do? Well, you take loan against these PPLI, these insurance policies. And remember, we said in the first segment, loans are not taxable. So you're putting the money in to take it back as a loan, not pay any taxes. And when this money keeps growing, when it goes to the next generation, how much tax do they pay? Zero.
Zero, of course.
Because when you have the inheritance, when the money goes to the next generation, it goes at the market value, so the step-up basis. So if you use the PPLI type of plan, you can avoid paying taxes when you're alive and pass on the asset to the next generation at no tax.
Is it really worthwhile to do that you pass it on to the next generation, give them liability to pay the taxes?
Well, that's the whole idea. You don't want to give them the liability. That's why all these concepts with 1031 exchange, swap till you drop, PPLI, all these concepts that we use in Millionaires classes, in Millionaires tax planning, to avoid to have the next generation pay the taxes. We want to make sure we come up with a plan where either the taxes are paid at the plan level,
correct,
or taxes are eliminated completely.
Okay, so taxes can be eliminated.
100%, especially when you bring in the inheritance angle to it. There is a step-up basis to the asset. If you do it right, the next generation does not have to pay the taxes.
Is there any limit on it, that how many millions?
Well, 100%. Yeah. I'm glad you asked. So right now for 2025, the limit is 13.99 million. If you do 706 filing, portability filing, you can combine the two limits, meaning husband 13.99, Wife 13.9, it's almost 28 million. So I had a client. The client says, hey, I don't have 28 million right now. I have only few million. I don't need to do the planning. And I said, you are 50 years old. Even if you stop working, let's say if you have $5 million, at 10%, this will double in 7 years at 10%. So in 15 years, this 5 million becomes 10, becomes 20. So this person will have 20 million in 15 years. He's 50 years old. Even if he stops earning, even if he stops growing the asset, he will still be above the limit. So the idea here is, even though the limits are, let's say 13.99 or 14 million per person or 28 million, but if you are above certain threshold, and the threshold I see right now is 4 million, 5 million, 6 million, you decide. But think about it, explore it, look into it.
Interesting, very interesting. Thank you so much for that. Now, while we're talking about PPIL, another topic comes to my mind is maximized deductions. What are the deductions, the maximized deductions that can apply to these millionaire tax strategies?
Absolutely. So the way I look at it, penny is a penny. You're a millionaire, you're not a millionaire. This strategy, what we call maximizing deduction, applies to everyone. So if you go to the itemized deduction section, you have the medical expenses that has to be in excess of 7.5%. You have the SALT deduction, which has been increased with the new bill, with the big beautiful bill, from 10,000 to 40,000 now. There are income limits. If you are making more than $500,000, it starts to phase out. It does not go away. 10,000 is still guaranteed, but be aware of it. Then you have charitable contribution. From 2026, there are some rules change, meaning charitable contribution for individuals are allowed in excess of 0.5%, which is still okay. You can, I mean, it's not applicable to 2025. The idea is, if you are aware of how does the concept work, if you can maximize the medical expenses, state and local taxes, mortgage interest, which is limited to $750,000 of indebtedness, if you can plan your charitable contribution, if you have gambling losses, plan it properly. Gambling losses are going to be deducted at 90% in the future. So, I mean, plan these things properly so you can maximize your deductions. A deduction means your taxable income goes down. Let's say if you are making $100,000, 10,000 of deduction means you pay tax on 90. 20,000 of deduction means you pay tax on 80. So maximize your deduction to minimize your taxable income. The idea is you want to make more money. You just don't want to pay more taxes. So when you make more money, if you can maximize the deduction, your taxable income will go down and your taxes will go down.
And that's right, and that goes along with Science CPA's motto, which is to do taxes right. It doesn't matter that refund or to pay Uncle Sam, but to do your taxes right. And just like AJ says, that if it allows you all these deductions, then why not take it? And why not imply it to your tax return? All right. So moving on to the next one, this perhaps the next category is mainly for the investors who are heavily investing into a real estate business, and it has to do with cost segregation, because there's the depreciation involved for the property. And how does cost segregation and depreciation come along in that category?
Absolutely, Sanjeevji. So the idea, the concept is, so when you buy a commercial building, you're supposed to depreciate it over 39 years. Let's say you buy something for $1 million. Now you divide by 39, roughly 40. So you claim 25,000 every year in depreciation. Depreciation is a deduction. Deduction means it reduces your taxable income. And every year for next 39 years, you get roughly 25,000 that you get to deduct for your depreciation. If you do the cost segregation, segregation means separating out. So you say this building is $1 million, but the furniture that this building has is not going to last 39 years. This furniture has a life of 5 years. The loan, the outside loan that you see outside this building, that's going to last only 3 years. These lighting, the fixture is not going to last more than 7 years. So you divide the $1 million, 200,000 for the loan, which can be depreciated, amortized over 3 years. That's 60,000, 65,000 right there. If you have furniture fixture, let's say furniture fixture is another $200,000 over 5 years, you got another 40,000 out of depreciation. So when you divide the total cost, $1 million in this example, into multiple pieces, where the depreciation related to that piece is not 39 years, is 3 years, 5 years, 7 years, 10 years, you get to claim a much larger depreciation. in the building. So the idea is, how do I maximize my deduction? And depreciation is a type of deduction. You want to maximize the deduction to lower your taxable income. So by doing the cost segregation study, and you say, well, the concept is good. How do I go about it? There are companies. There are companies only doing cost segregation study. They will stand behind it, that they have looked at the building, they have looked at the market value of all these assets that you have, and they will give you a complete report with calculated depreciation, as this is 5 years, this is 3 years, this is 7 years, and this is how you can calculate the depreciation, increase the depreciation to lower your taxable income.
Amazing, amazing, very, very interesting. And viewers, I'm sure that any one of these tax strategies will definitely apply to you. This is a Millionaire Tax Strategies episode, and this is a part 1 of total 2 parts. The next one is going to be second part 2 of 2, because it's very impossible to cover all the topics. Today, we covered 6 of them. I hope you have made a note of it. You can watch it later on a YouTube channel. Also, make a note of it. In the next episode, we're going to cover other 6 topics as a part of Millionaire Tax Strategies. This entire project, the concept initiated by Mr. Ajay Kumar of Science CPA Services, to inform you and to educate you, to all the millionaires out there, that what are the strategies that you have that maybe some of them will definitely apply to you, so that way you can have your deductions that you're entitled to and file your taxes. And as Science CPA Services believes in doing taxes right, you can give them a call at 908-888-8900 or visit their website sciencecpaservices.com. AJ, many thanks for your input and sharing your knowledge here. We really appreciate it.
Thank you, Sanjuji. Thank you.
All right, with that note, we come to an end of this episode. I am Sanjeev Pandya, wishing you all happy and smiley and tax-free days ahead. Until we meet again, same place, same time, so long.
Thank you.